Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we got so many things. We had such a hard time picking just 3 topics today because there's so much going on. But we did pick to talk about today Apple CEO Tim Cook. He pulled 3 rabbits out of a hat. We'll explain what that is because we're against Apple probably. Well, we'll talk more about that. We'll explain what's going on there. In 2026, you could be buying stocks on the Texas Stock Exchange. Yes, that's going to be a real thing. And then public companies that bought Bitcoin, well, they're getting worried now. We'll tell you why they're getting worried and what companies are doing about it and what's happening to people that invested in those companies. Chase, what companies are we looking at for investment?
Yeah, companies we're going to look at, I've seen this real estate play around. They have some beautiful buildings generally in the healthcare space, but we're going to look at this business called Alexandria Real Estate Equities. We're also going to look at Kimberly and Clark, who just announced they're going to buy Kinview. It's kind of surprised by that. And then Chipotle, Mexican Grill, and Newell Brands. So we got a full slate. You might not recognize Newell Brands, but I'm sure you recognize the name Sharpie.
Sharpie, yes. I heard their sales are down on Sharpie. They're not so sharp any longer.
I don't know.
Well, we'll talk about that one. See if it's a buy, so we'll talk about that. But let's talk about Apple CEO Tim Cook pulled 3 rabbits out of a hat. Now, pulling just 1 rabbit out of a hat is a pretty good trick, I got to say that. But pulling 3 rabbits out of a hat, well, that's nothing short of a miracle. Now, in the spring of this year, 2025, Apple stock fell below $170 a share, and it was faced with enormous tariffs on the iPhones. The potential loss of $20 billion per year payment from Google, and while sales for the iPhones, well, they just seem to be stuck in the mud. And I was worried back in the springtime.
Yeah, and when you look at Tim Cook, I mean, I'm going to say he's a great operator, right? I think he's very efficient in running the business of Apple. He's not Steve Jobs in terms of the creator, the innovator, but it's impressive how he manages such a large business and the efficiency that he has.
And he's got to be a great negotiator. What he did, we'll explain, but he's got to be a great negotiator.
Yeah, I mean, to that point, I mean, you look at the tariff situation, right? To handle that, Tim Cook did promise U.S. investments of $600 billion over 4 years. And this wasn't necessarily what President Trump wanted to the exact extent, because it's not bringing iPhone production back to the U.S., but it was an investment of making AI servers in Texas and offering manufacturing training for U.S. businesses in Detroit. Apple also announced a $2.5 billion commitment to make iPhone cover glass in Kentucky with Corning and a $500 million partnership to produce rare earth magnets in the United States. Now, after this investment pledge, the president said Apple would be exempt from tariffs on imported electronics, which obviously was going to hit them very hard as a lot of their products come from China. Now they're trying to shift to India, but obviously there's some tension between the U.S. and India as well. So, I mean, this would really hurt Apple quite a bit in the bottom line. And I'll say the other thing, too, that Tim Cook did is these big pledges that they're promising. I don't have the exact dollar-for-dollar accounting, but it's a lot of partnerships and other companies kind of doing. So it's not like Apple's writing a check for $600 billion. They're kind of getting other companies to take place in it. And again, I say this all the time. Apple, great business. I think Tim Cook, again, not a great innovator in my mind, but a great leader and a great manager of this business. But it's just, we'll get into the valuation, it's just too expensive.
And you're right, because they did say that he's not done any innovation. He's not Steve Jobs. They do say the next CEO, because Tim Cook is now 65. Yeah. The next CEO, they're saying, we do want somebody that's an innovator, taking nothing away from Tim Cook because he is a great operator of the business. He's done very well moving that company, having that company grow, growing the stock. Some things he says like, wow, I mean, we can't believe where the stock's at. But let's talk about to save the $20 billion yearly payment from Google. That was a big thing because we said, if that happens, that's $20 billion of pure profit they're going to lose. I mean, they had so many things against them. We said, no, the stock is going to have some problems. But Mr. Cook, another smart thing, sent Apple's senior vice president in charge of services, Eddie Q, to testify at court. Now, Eddie Q convinced the judge that technology shifts are so powerful that they can take down even the most massive of companies. In other words, the judge did not need to impose harsh penalties, and the market would eventually, well, take care of itself.
The other interesting thing, and I've talked about this before, is I still don't know why Google Alphabet pays $20 billion for this.
I don't
To
either.
me, it just doesn't seem like there's very good ROI at this point in time, especially now with the kind of advancement and popularity of ChatGPT and all these other, AI tools, the Perplexities, the Claudes, Anthropics. There's so many out there. I just don't see how that $20 billion is going to pay off for them.
For Google.
For
Yeah,
Google.
right.
For Google. Obviously, it pays off great for
Yeah,
Apple.
of Apple. Yeah, and that's the thing too. I want to make sure that people understand that he convinced a judge, like, no, you don't need to take that away. We'll have other problems. So therefore, Apple still gets that $20 billion every year.
And I just almost wonder if, like, Google, Alphabet, they're just too scared to rock the boat with Apple, that if they say, oh, we're not going to pay the $20 billion anymore, they're like, fine, we'll really push you down. And it's like, maybe that's why they're still doing it. They're kind of pigeonholed, but it just doesn't make sense to me why Alphabet makes that payment.
No.
I don't think they make $20 billion off that deal. Generally, companies, when they invest $20 billion, they want to make $30-40 billion off of
Yeah,
that.
yeah, that's not a break-even
case.
thing.
Also, too, we talk about another thing he did that was pretty phenomenal is somehow consumers have been convinced that the new, and this just blows me away. I was looking at this the other day. I was like, what? The thinner smartphone called the iPhone Air it's a must for consumers, people think. The marketing has to just be phenomenal because the iPhone Air has a weaker camera, a single speaker, a smaller battery with a shorter life, and this is what gets me. A higher price tag. Hey, let me give you a worse product with higher price. It just doesn't really add up. And I would understand, maybe before like the iPhone SE, right? It came with a cheaper price tag. So that's why you were okay to give up some stuff. But all you're getting is a thinner phone and that's worth more money? Especially if you have a thinner phone, you probably need to put a case on it. So you really lose the thinness of it at the end of the day.
And and I don't know. I mean, sometimes where's my phone at? Now, if it's so thin and so light, you won't be able to find your phone because it's so thin and so light. But you're getting less production out of the phone, which is kind of strange.
And I don't know why they did the iPhone Air or whatever they're calling it, because to me that just adds expenses because they might have already been upgrading to a different iPhone. Well, why would you add now the complexity of a new SKU or a new product when it really, I don't think, creates much value? But I mean, the other thing too, when you talk about this iPhone 17 lineup, Apple seems to have convinced people it's worth an upgrade. For me, I don't really see the big deal. It seems exactly like the other iPhones to me, but hey, people might prove me wrong on that. And with this excitement around the iPhone 17 lineup, Apple is now predicting up to 12% revenue growth in the holiday quarter, which was twice what Wall Street estimated.
And and it's funny. I mean, I don't know why. Like, to answer your question, why do people keep upgrading the phone? I mean, I don't even know what number I have. Do I have the 12, the 15? I have no clue. I will get a new phone when it just doesn't work. Why would you go out and get the iPhone 17 if your phone is working fine? Because they're not cheap, and you're paying for it somehow. I mean, take that money, put it in your 401k, do something else with it. I mean, it's just, if your phone's working, everything it does, I just don't get.
Well, and last time because my phone broke the last time I had to get a new one. And
you had an 8 or something.
Yeah. And I think I got like the 13 or something. I think I have the 13 now. And I remember it was after the 14 came out, but I'm like, I'm not going to get the 14. It's like Verizon wanted to charge us, I think, like $40 a month for the 14. And I said, well, how much is the 13? They said, free, as long as you stay with Verizon. I said, well, I'll take that one. And I don't see the differences, and I'm not a techie, I guess, but, it is what it is.
Maybe it's like designer brands. You go around like, see, I got the new iPhone 17. I financially, I don't see the point of it, but... So let's kind of summarize this for you. In roughly 6 months, the stock, after dropping to a low of $169 a share, is roughly up $100 and somehow supports a PE, a price earnings ratio, of 36. Now, I got to say, congratulations to Tim Cook and shareholders who held on to Apple stock. But if anyone said they knew Apple would be fine, either they have a working crystal ball that really told them this is going to happen, or they really did not understand the problems facing Apple, because these were enormous problems. And I thought for sure that the president was not going to relieve the tariffs because he did the first term. this time. Like, no, not going to do it. I mean, again, they did a phenomenal job, but there's no way somebody can tell me, well, I knew this was going to be okay. No, I'm sorry. You're lying to yourself.
Yeah, and I'm going to say we're talking pretty positively about how they managed through this situation, but I'm not going to say I'm giving the A-OK to go ahead and invest in the stock. I mean, there's still a bumpy road ahead. When you look at operating expenses, I was kind of surprised by this. They did come in slightly over $18 billion, and this is an estimate. This is not real expenses yet. So this is the estimate for December. They're looking at about $18 billion. That's a 19% increase year over year. And like we said, revenue's estimated to climb 10 to 12%. So you're not even keeping up with that revenue growth on the operating expense side. And I don't see anything coming out of left field to create this big drop in the share price, but I just can't see anything that's going to cause it to continue climbing going forward. I mean, they got through all the negative news, so they're not really butting up against much negativity at this point. It's expensive. And for me, it's like, we also talk about Costco. Costco is trading at 50 times earnings. I mean, yeah, maybe Apple goes to 50 times earnings, but I don't want to take that bet. I mean, it's much more likely that Apple goes back to a historical multiple of 16 to 17 times than an outrageous multiple of 50 times.
Right. Yeah.
But if you hold Apple, that's what you're betting on. That multiple is going to keep going and going and going. And at 36 times the trailing 12 months earnings, it's expensive.
Yeah, I think what we're saying, you probably won't see Apple back down to the 170 level, but it could very easily fall 10, maybe 15% down to low 200s or so. But there's very little chance of it going to 320, 350. There's just no reason for it. And if they do have, I mean, this past week they had, more layoffs expected. I think things kind of stumble a little bit. If we don't have a phenomenal holiday season, they don't do, what you say, a 12% growth on the sales for the holiday season. If they come in at 8%, still grew, but that's way off the mark.
Well, that's where I disagree. I mean, you could have Apple get taken down, and I think things are going well.
What would take it down? What do you think?
If you miss, if you come in and they're now saying 12%, and all of a sudden, and this is the funny thing with Apple, is you keep talking about this super cycle that's coming, It's almost like it keeps pushing the stock and not allowing it to dip too low. But if the super cycle never actually really comes and revenue doesn't come in at 12%, it comes in at, let's say, 5-6%, that'll take Apple down, I think. Yeah. If you miss expectations on a stock trading at 36 times earnings, I mean, it could easily, I think, fall 20, 30, 40% if it is a bad miss.
Yeah, I mean, I'd bring it back to reality, I guess, so I think you could be right. So be aware. So, all right, let's talk about in 2026, you could be buying stocks on the Texas Stock Exchange. I love this story. Businesses and CEOs are getting tired of the high taxes in New York City and the regulations that are costing them billions of dollars. Texas, which is known as being a pro-business state, will be opening in Dallas the Texas Stock Exchange. TXSE will be the ticker symbol there. This has already been approved by the Securities Exchange Commission, the SEC. It is expected to see operations open for trading in the first quarter of 2026. That's not that far away. That's less than 6 months away.
Yeah, and I mean, it is getting some solid backing as well. You look at JP Morgan Chase, they actually just invested about $90 million in the new exchange. And other large companies like BlackRock and Charles Schwab, they're also on board. And it's also backed by many business people, including billionaire Kelsey Warren, co-founder of Energy Transfer Partners, and billionaire Paul Foster, who founded the investment firm Franklin Mountain Investments.
And this could be a heavy blow to New York and New York City, who have, well, they've been unfriendly to business for quite a while now because they felt like they were the only place in the country to trade the New York Stock Exchange. That's the big one. Now that New York City has elected, gosh, I hope I get his name right, Zohran Mamdani. Is that how we say it?
It's Zohran Mamdani.
Mamdani. For mayor, it'll be interesting to see how businesses respond, since he says he will go after businesses and the wealthy to pay more taxes. That would probably be the best advertisement that the new Texas Stock Exchange could ask for, because you're not business friendly in New York, going to pay more in taxes, business, everything else. Come to Texas. Come to Texas. We got some great things here for you.
Talking about great things. How about no income tax?
I like that. Maybe we should go there.
And I mean, kind of comparing that to New York City pre-Mamdani. In New York City, you pay a state tax of 10.9% in the highest level, plus a city tax. I didn't know they did this back in New York, but cities can charge their own income taxes as well, and that can be 3.9%. And it doesn't take long to get into those levels based on your income, especially if you're I'm going to say a banker
Right.
working for one of those companies near Wall Street. It's like, hey, I'll take a little bit less pay to go to Texas.
Yeah.
I mean, now that you have this option, I was surprised by this. I was reading an article too that JP Morgan actually now has more employees in Texas than in New York.
And they just built that big building in New York. In New York City, yeah, and again, I've heard the new mayor now speak like, so if you're making $1 million, you got to pay $20,000 or more in taxes. That's just like a drop in the bucket. No, because you got to pay the taxes on top of that. So your net after all your taxes, not $1 million, you may end up with, after federal, state, and city, you may end up with $600,000. Now it's $20,000 more on $600,000, not in $1 million. And I just think that Texas is on track with business. New York City, it's going to be quite the experiment. We'll say what happens, and we'll see.
I've said this before. I don't know if I've said it on air, but here in San Diego, people are always like, "Why do you live in California? The income tax is just outrageous." Like, I went to Arizona. I hate the heat. I hate the humidity, and I mean the weather is just hard to beat. I mean, you're from upstate New York. What the heck's in New York? People, they go down to Florida half the time anyways. And I'm like, What is keeping people in New York? It's those jobs in the financing career. You want to make it in Wall Street, you have to go to New York. You have to go work for the Goldman Sachs. You have to go work for the JP Morgans. All of a sudden, now you have that option at Texas. It's like, I don't have to go to New York. And I'm not saying I think I'd rather live in Texas. The humidity would probably be rough, and they have the hailstorms and stuff. But at least you have no income tax. It's not like you're comparing Texas to San Diego in my mind. You're comparing Texas to New York City, and I don't think the weather's much better there.
No, and also it could be like California, where a lot of manufacturing left California, went to Texas, went to other places, and that could happen in New York City. They say, well, what is the point being here? Especially, again, you said JP Morgan Chase has more employees down in Texas than New York. You got Goldman Sachs. You got some major brokerage firms there, BlackRock. I say, I think we'll move half our employees down there. It could be devastating, but great for the new Texas Stock Exchange.
I'll be very curious to see how this all plays out next year.
We'll be watching it. We'll keep you posted. Let's talk about public companies that bought Bitcoin. Well, they're now getting worried. The craziness of public companies riding the Bitcoin wave as an increase in value caused many of their stocks to jump even more than the increase in Bitcoin, or other cryptocurrencies as well. I want to include those too. But now that Bitcoin has pulled back from its all-time high of slightly over $126,000, and it has dropped about 20%, well, those public companies that bought Bitcoin are seeing their stocks drop far greater than the decline in Bitcoin.
Yeah, this past week, we actually did see it dip under that $100,000 mark.
99,000 something.
Yeah. So, I mean, it's a pretty substantial decline, as you said, about 20%. Now, roughly 25% of the public companies that bought Bitcoin as a treasury strategy now have a market cap valuation below the total value of their Bitcoin value. What companies were doing was they would, and this cracks me up, invest in Bitcoin, then sell their shares at a premium as their stock increased in value due to all the hype around it. Then they would take those proceeds they got from selling their stock to turn around and buy more Bitcoin. Now that Bitcoin has declined, though, there's no reason for crypto buyers or traders to buy those stocks, and instead it looks like they have been selling them.
Yes, and as an example, Clean Core Solutions is now down, listen to this, over 80% since investing in Dogecoin, and even a larger player like Japan's MetaPlanet, which is a top 5 publicly traded listed Bitcoin holder, has seen its stock decline around 60% over the last 3 months. Now, if Bitcoin were to continue to decline, the company could be forced to sell assets, which could cause even Bitcoin to fall even further on top of that.
And so far, this hasn't necessarily affected the company and their strategy, I'll say, who started this craziness of buying Bitcoin in their treasury. And of course, I'm referring to the company MicroStrategy, which changed its name just to Strategy, and still trades under the symbol MSTR. And the thing you have to understand is really all this company does is buy Bitcoin. And maybe that's why they changed their name to Strategy, is because it's a Bitcoin strategy. It's not a business.
Right. Yeah.
That's all it is. And when you look at Strategy, it owns roughly 640,000 Bitcoin. And at today's price, it's worth roughly around, I'm going to say, that $65 to $70 billion range. And obviously, Bitcoin's quite volatile, so it can move around quite a bit. But we'll say around 65 to 70 billion as we're talking today. It is estimated, though, that Strategy's average purchase price for Bitcoin is $74,000, so they seem to be safe for a while until they start dipping into that break-even/negative territory. However, stock investors in Strategy are probably crying the blues since in July, the stock was around $450, and as of today, it trades right around $240. That's close to a 50% decline.
Yeah, and I know with the strategy, that they said, oh, well, the reason why you buy us is because, you can trade options on it, you can do margin on it, you can do a lot of different things. But it's never made sense to me to buy strategy because of the Bitcoin. And it's getting hammered. And as we've said for years, no one really knows. I don't care who they are, what the direction Bitcoin is going. I'm sure you have many people, oh, I know where it's going. They don't. It could be up or it could be down. But one thing is for certain, if those companies that bought Bitcoin and pushed the price higher now need to sell, well, that will probably cause Bitcoin to fall even further because they're going to supply demand. I mean, if the demand's not there and the supply is increasing, the price of Bitcoin will fall further. So we'll see what happens there.
And this is the problem with a lot of these cryptocurrencies is when you look at all the craziness that goes on there, not just even talking about, the individuals owning Bitcoin. We've talked in the past about the leverage on these cryptocurrencies. Now talked about these companies that have bought Bitcoin. That leverage and these companies buying Bitcoin is causing the price or has caused the price to go higher. But on the downside, if all of a sudden companies go, oh my gosh, the strategy is not working for us, and as you said, they have to turn around and sell it, well, then that causes it to go lower. Now you add the added layer of leverage. Oh my gosh, now people are getting margin calls. Now they have to sell. I mean, you could see this thing fall so quick. You would have no idea what hit in the face.
And I think it was last week. It was either a newsletter we talked about on the radio show about the leverage, not here in the U.S., but around the world, where sometimes it'd be 100 times what you're paying. If that starts collapsing, wow, step aside because there's going to be some big drops there. All this information does come in our newsletter, the Smart Investing newsletter. It goes out every Friday to 5 o'clock by email. Other topics there are sales, electric vehicles killed Porsche's profits. New estimates show in 2033 retirees will lose $18,000 a year in benefits. Job losses are increasing in white-collar jobs. Was that crime? Jobs. If I wasn't a value investor, I would consider putting Tesla stock in our portfolio and have some retirees become too comfortable with gains in stock markets. It's a free newsletter, very informative. People love it. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up, and it'll go out every Friday for you at 5 o'clock, and past issues are there as well. Let's move on to companies. I mean, time's just going by here very quickly. We're going to talk about Alexandria Real Estate Equities. I think you pulled this one out. I've never seen this one before, but
they have a few properties here in San Diego. I've seen them around town. I think they have one over in La Jolla that stands out. It's actually right across from like the Torrey Pines Golf Course. Mm-hmm. Beautiful, beautiful properties. I think they also have one like off the 56 or something as well. But yeah, they have some very nice properties that's generally in the healthcare space.
Well, let's take a look at their symbol is ARE. They're in the real estate industry, REIT office industry. Not much on the short side, 3.7%, 96% institutional owned. No PE ratio. Again, we talk about FFO, so that don't worry about no PE ratio. Price of sales, 3.1 versus 4.5. Price to book value, very good, 0.6 versus 0.9. Price of cash flow, 6.6 versus 10. And let's see, no earnings over the last year versus the industry. Same thing with the 5-year. Sales, unfortunately, are down 1.6%, but the industry is down 16.3%. And they show a 5-year EPS growth estimate from the analysts of a drop of 2.2%, but that is far better than the drop in the industry of 23.1%. Now, you do get a dividend here. Now, the yield is 9.9%. The free cash flow payout 65.5%, so that is a positive that they seem to have that coming on through. And again, you got depreciation, other things here that you got to look at, but you got to dig deeper to make sure that is a safe 9.9%. That's pretty high. We do see on the balance sheet current ratio 0.3 versus 1.2. That worries me a little bit. Debt to equity 0.8 versus 1.1. I say current ratio 3.3%. That's not a lot of liquidity. That could be a major concern for me. Net profit margin is negative 13.8% versus a positive 6.7%. Return on equity a negative 2.5 versus a positive 3.4. Free cash flow does look good. This can help the dividend. It's $1.376 billion versus $413 million for the industry. So that's pretty good. And free cash flow as a percent of sales is 46.2%. So what do you got going for? And that's the important part where we look for the free cash flow or the
FFO.
FFO.
Yeah. And FFO, I don't know if you already covered it, stands for funds from operations. Gives us a better idea than earnings for a company since, they're going to have depreciation. That's an expense to a higher magnitude a real estate company would have than a non-real estate company. So we kind of look at that FFO as a better guide than earnings. But giving you the current price here for Alexandria Real Estate Equities, again, their ticker symbol is RARE. It's $53.17. The 52-week range here, the low $52.94 and the high $114.69. And this stock, it's been under pressure to say the least. Year to date, it's down 44.8%. 1 year down 52%. 5 years not getting any better, down 66%. 10 years down 37%. And it looks like they had a pretty sizable decline of around 16% last week after they missed earnings and then also lowered its full year profit outlook. So the market did not like that, and it took down a stock that has struggled immensely, to say the least.
Right. And you do have the FFO numbers going forward, correct?
Correct. Yeah, we go out to December 2026. I see estimated FFO for the business is $7.41. It gives us a target sell price though of $123.01. So the valuation is there on the cash flow. It's about 7.3, 7.4 times that future FFO. But the interesting thing is FFO is estimated to decline 5% this year and then estimated to decline 17% next year.
Right.
That's a big decline in cash flow. What the heck is going on? Did they have to refinance a lot of debt that is, at a higher interest rate now? That is generally not something you want to see in the real estate space. You want steadier cash flow, growing cash flow.
And we do hold in our portfolio an office REIT, which they report earnings, and they were phenomenal. Everything. It's like they're ticking all cylinders. The reaction on the street was, big yawn. Yeah. Who cares? And it's funny. I made a big deposit into my investment account yesterday, and I was so excited to do the buys today. It's like, doggone it, our real estate REIT that we have in the office REIT is above our target buy price. I couldn't buy it today, but I think it is phenomenal what that one's doing. But we know that one very well. You'd have to dig in deeper to this one here to see what's going on behind the scenes.
Yeah, and this one, they call it a cluster strategy, so they really only focus on certain cities, like they're in Seattle, San Francisco, San Diego, New York City, Boston, Maryland. So, they're really only in those cities.
Yeah, ours is in the Sun Belt. Yeah. So that could be the big thing. What is it? Location when it comes to real estate. This one may not have that. So, all right. When we come back, we got our financial planner Harrison Johnson coming up, talking about the conflict of interest around universal life. I don't think there's no conflict. I think it's just terrible. But we'll talk more about that. Stay with us. This is a Smart Investing Show with Brent Chase. We'll be right back. All righty, welcome back to the second half of the Smart Investing Show. And with us, we talk about financial planning, the first part here. And with us is Harrison Johnson, CFP with Wilsey Asset Management. And Harrison, talk about the conflict of interest around universal life. And I said when we came out of the break, or going into the break, why aren't we talking about universal life? But it's a conflict. You're saying people are not really, they think that they got something when they really don't or something.
Yeah. So, and this again deals specifically with universal life insurance. So there's different types of life insurance: term, universal, whole life. A lot of people kind of think of universal life insurance as a hybrid between term and whole life. And one of the things that differentiates it from the other two is it has a flexible premium. So what that means is the policyholder can really pay whatever they want to into the policy. Now, universal life and all life insurance has costs baked into it. So there's policy fees, administrative fees, different types of fees in there, and then there's the cost of insurance. So no matter what you pay in form of a premium, there's always this cost, but if you pay a premium that's more than what that cost is, that excess gets put into cash value, and then that can grow over time. And so where the conflict of interest arises is when an advisor sells a policy, they say, well, it's got cash growth, tax deferred growth. If the cash value grows large enough, then you can borrow against it. That borrowing is considered a loan, so it's tax-free. It can be a form of tax-free income, essentially. So it has these potential benefits along with it. But the issue is when a policy is sold, whoever sells it earns a commission. The commission is based on what's called a target premium, which is essentially a low-level premium necessary to keep the policy in force. So the advisor is not incentivized to make sure that the policy owner funds it properly. They are incentivized just to sell it. So what I see a lot is on the back end, somebody has one of these policies and they say, oh, it's got money in it. It's been growing. It should be, I'm almost going to retire soon, so it should be able to start producing income. And I'll look at it and there's no money in it. There's no cash value. And that's because they weren't funding it properly over time, because the advisor sold it to them, earned their commission, and didn't tell them how much they really needed to be putting in there in order for it to produce the results that they were expecting.
How do people get confused? Because you said that there's a person that you had to tell them they thought they had a lot of money in it, and you looked at it like, no, there's nothing here. How do they get confused where they think they have something when they really don't?
Well, with life insurance, you always have a death benefit, right? And so you might have a death benefit of $100,000. So I had an example of this where there was a $100,000 death benefit. This person had bought this policy, 20 years past, and they thought that this was $100,000 because it was a universal life insurance policy and the cash value was supposed to grow. So they thought they had $100,000.
So they thought the death benefit was the cash value. So that was just
they didn't fully understand it.
Yeah,
So they didn't really differentiate between death benefit and cash value, but they just remember what they were told when they bought the policy, that if you put money into this, you'll be able to use it as a form of retirement income. And so when they would look at their statements over time, they just see this, $100,000. They don't really know what a death benefit is or a cash value or anything else. So they, for decades thought that this would eventually, be $100,000 that they could use. And then I had to tell them there's actually no money in it. So, if you die, $100,000 goes to the beneficiary. But
so it sounds like they bought an expensive term policy.
I was just talking to Chase about that in the break, because what happens is, let's say you buy a universal life insurance policy and it's $100 a month, just making up a number. Well, in order for it to build cash value, maybe you need to put in $500 a month so that extra can accumulate. But if you're only putting in that 100, which is the target premium, it never really builds cash value. And so now you have this death benefit when you could have just bought a term policy for maybe $25 a month to get the same death benefit. So you're exactly right. If you're not funding it correctly, it's basically a very expensive term policy. And a lot of people aren't aware of that until, they try to use it and there's nothing in there.
A couple of thoughts here. I mean, the problem with annuities, life insurance, they're contracts. They're not investments. They're contracts. And you have to understand how the contract works. You add in all these layers of complexities that people don't understand. And it's like, oh, yeah, I have 100,000. It's like, that's your death benefit. Well, what's that? It adds these different layers that people don't understand. And, it's interesting, kind of within a pretty short time period, I was also talking to another new client, and she's like, oh, no, I have this life insurance policy. It's great. They told me that, when I put the money in, after 10 years, if I didn't need the life insurance, I can get my money back. Same thing. I looked at it. No, there's no cash value in it. So if you want your money back, there's no way to get it. I mean, you can stop paying the life insurance, but now that's uninsured, and you just wasted 10 years of premium payments.
That's another one that we were looking at.
It's a sales tactic of people telling somebody that something that's not necessarily false, but it has to be done properly. And the other qualm I have with this is I'm not saying that overfunding the life insurance is a good idea.
Right.
But the problem here is people aren't buying what they think they're buying.
And that's where the conflict of interest arises. So again, if the target premium's $100 a month. If you're actually supposed to put in $500 a month to get all those extra benefits that, come along with it, with the cash value accumulation and everything else. But the advisor who sells this, whether that policyholder pays in 100 or 500 or something else, they essentially earn the same commission. So, they will say, well, if I sell a term policy, premium's only $25. I'm not going to make much money. This universal life insurance policy has all these extra benefits. It's more flexible and it's not quite as expensive as whole life. So go ahead and buy this one, and it can be a retirement income stream. But after I sell it to you, I don't really care what you do with it because I earn my commission, then I can go sell another one to someone else. So that's where the conflict of interest arises. And Chase, you're right. Even if it's funded as efficiently as it possibly can be. I still don't think it's a good investment compared to other alternatives out there, like actually investing money. But I hate to see, when I have someone who's getting ready to retire and they think they have a source of income here that is actually not there.
Yeah. I'll tell you what you do instead of a universal life policy. Term insurance, as we said, cheap term insurance. And then if you don't need the term insurance anymore, you drop it. And then max out your 401ks and your IRAs.
Yeah.
That's it. That is far better than doing this.
Wait a minute.
Universal life
Don't
policy.
you get a tax deduction for doing that too? What you don't get for insurance?
Well, yeah,
People sell it as it grows tax-free. Great. So do Roth IRAs.
So do Roth IRAs,
way
exactly.
better.
Premiums that you pay into life insurance are made with after-tax dollars, and then the death benefit, or if you borrow against it, that's a tax-free. But that's just like a Roth. So there's always going to be a more efficient investment account, whether it's a traditional IRA, Roth IRA. Even I would put money into a taxable non-retirement account before I would buy permanent life insurance of any kind. So there's always going to be a better alternative. But, if you have $100 a month to put it into an investment account versus $100 a month to put into an insurance policy, the commission that comes with that insurance policy is much, 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 much more than what an advisor could earn by, having an account that you're putting in $100 a month into.
And I know we got to wrap this up real quick, but I'm guessing here, but I think the experience of the average life insurance agent is very low because there are young people that get in there. They don't know what they're doing, and then they're there. Maybe
That's another thing that I had talked about in this part of the newsletter. There are advisors out there who sell life insurance that might structure them correctly, but because that field is so easy to enter, you don't need a lot of education. You don't need a lot of experience. There's not a lot of testing that goes into it. It's very easy to enter, and so that can attract all kinds of bad actors who, can get into that just because they want to sell things and make money.
And they may not be bad actors intentionally, but they just don't know what they're doing.
They might not be aware of it. Yeah.
Might not be aware of it. And somebody told them to do that, like, oh, okay, that's great, And then they do it like, oh, I burned people, didn't know it.
Right.
So
exactly.
It's a shame. So, well, Harrison, thank you very much. We appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is a CFP. He's with our financial planner at Wilsey Asset Management. If you want to talk to him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. You can have a free consultation with him as well. Or go to the website, smartinvesting2000.com. You can send an email right there. You'll see his email address there. Again, smartinvesting2000.com. All right, let's go on to our next company here. And this company's been in the news, I think, for the past week or so, right? Talk about Kimberly-Clark. Their symbol is I almost said KFMB, KMB. Household and personal products, that's the industry that they're in. There's nothing on the float or ownership here, and I'm not sure why that is, but we'll move on. We do say they do have a PE ratio of 17 versus 25.1. Price to sales 1.7 versus 2.5. Price to book value is expensive, 25.1 versus 4.9. But price to cash flow does look better at 12.8 versus 16.8. Again, valuation ratios, you want them lower than the industry average. Pretty good PEG ratio, 2.4, nothing for the industry. We do see over the last year, their earnings are down by 23.4%, while the industry was up 5.6%. That's not good. We do see sales fell by 1.9% for Kimberly-Clark when the industry was actually up 1.3%. Now, they do have a good 5-year earnings per share growth estimate from the analysts of 5.8% positive. The industry's a negative 9.7%. You get a nice dividend here, 5%. They use 84.2% of their earnings to pay that out, so that's pretty good. We do see a buyback yield of 1.2%. The balance sheet, let's take a look there. We got a current ratio of 0.8 versus 1. I'm okay with that, but I don't want it to drop much lower. Big problem here, debt to equity 5.5 versus 1.2. And I think what I'll try to do, Chase, is check the balance sheet when you're doing your research there. We do see that they have a net profit margin of 10%, just under the industry at 10.4. Return on equity, very good, 147.8 versus 27.3. So it's kind of telling me they probably have very low equity and maybe normal debt, but I'll, again, check that. Their free cash flow, $1.6 billion, below the industry at $7.6 billion. Chase, what do you got?
Yeah, so I'll give the numbers first, and then we'll get into the news of the week here. So the current price for Kimberly-Clark, it's $100.77. It has not performed well year to date. It's down 23.1%. 1 year, similar, down about 23.97. 5 years, gosh, down 26%. 10 years, down 15%. Definitely not a good performer. And this has been on the price return, not inclusive of dividends. So over the last 10 years, you probably made money because the dividend's decent, but again, probably not very much.
And they have well-known brand names.
Yeah, I was going to
brand
get into
names.
that after
Yeah.
the
Okay.
numbers here. But I mean, you look out to December 2026, you see estimated earnings per share is $7.54. It gives you a target sell of $125.16. So it's trading right around 13 times those future earnings, a decent value. But this is where things get interesting. I mean, the reason it is in the news this week is they announced they're going to be buying Kenvue. And Kenvue was spun out of Johnson & Johnson. Kenvue has brands including Listerine, I love this one, Band-Aid, Benadryl, Tylenol, and obviously Tylenol has been in the news for, pregnant women and how it's like, oh, don't take Tylenol if you're, pregnant, and, that's kind of hit Kenvue pretty hard. I'm going to say I was pretty surprised to see this announcement, and the market did not like it. The market sent Kenvue went up on the news, obviously.
Right, yeah.
Kimberly-Clark went down over 10% after announcing this potential acquisition if it clears. And the reason I don't like it is if you look at Kimberly-Clark, their brands include Kleenex, Huggies, Scott, the paper towels, the toilet paper. I'm having a hard time seeing how Tylenol fits in with Kleenex. I don't see necessarily the
you get a
synergies.
cold, you blow your nose, and you might take Tylenol.
Yeah, maybe. Package the two together. I don't know. But it just seems like it's not in their core competency, and it seems like it's a different business than what they're operating.
Yeah, I kind of see that a little bit, but I think maybe they're trying to diversify. But I said I would check the balance sheet for you here, and they do have a lot of debt, $6.4 billion in debt. Now, it is down from 3 years ago to $7.5 billion, but their equity is very low. Their equity is like about $1.3 billion. So not a strong balance sheet, and when you're doing stuff like this, and what I don't think's come up yet, maybe I'm wrong, any lawsuits against Tylenol. I don't think that's happened yet. And I say yet because you never know.
Yeah, I mean, it's possible that does occur. And, I was kind of looking at the numbers on this deal. And Kimberly-Clark and Kenvue say that they have identified approximately $1.9 billion in cost synergies. Obviously, that's going to come from, laying people off, kind of simplifying the footprint of the business and so forth. But they also said approximately $500 million in incremental profit from revenue synergies. That's where, again, maybe they bundle together, your Tylenol and Kleenex. Yeah. I'm not sure where that would come from.
Get a bottle of Tylenol, a box of Kleenex, yeah.
And they said partially offset by reinvestment of approximately $300 million. So that tells me there's really about $200 million in incremental profit there. But the cost synergies are expected to be captured in the first 3 years, according to them, following the closing. And when M&A to this magnitude happens, I got to tell you, I'm always very skeptical of these numbers. I always think they're overly ambitious, and many times I think they don't come to fruition. And your fear here as a Kimberly-Clark shareholder is that they obviously overpaid for Kenvue.
And I think they spun it from Johnson & Johnson
not too long ago.
Yeah, a year ago or so. And I'm thinking Johnson & Johnson didn't want it, which I think fits in very well to what they have. Why does Kimberly-Clark think it is such a good deal? I'm kind of missing that myself.
Yeah, so I guess it was 2 years ago. August 23rd, 2023 was when it occurred. But still, it's a very short time period to be a public company, about 2 years.
Yeah. So, not a buy.
No, I mean, the numbers, if it fell further, maybe warrant it, but I don't think I would step in and buy it, frankly, at these levels. I think there's other better defensive companies out there than Kimberly-Clark.
Too many unknowns and high debt.
Yeah.
$6.6 billion.
And that's going to go up even more. I mean, this is a $48.7 billion deal.
Is it cash or stock?
Cash and stock.
Cash and stock.
So that's going to dilute shareholders and also probably add to the debt side of the balance sheet.
Yeah.
Both negative.
Not a good thing at all. Speaking of not doing well lately, that maybe they need to take some Tylenol is a Chipotle Mexican grill. Their symbol is CMG. Now, not much on the short side. It's only 2.1%. Institutional owned about 90.5%. The PE ratio is 27.1 versus 28.9, so that's okay. It's still kind of high, but okay. Price of sales 3.5 versus 2.2. Price to book value 12.5 versus 15.7. Price of cash flow checks in at 18.7 versus 15.6, and they have a pretty good PEG ratio of 1.5. versus 17.4. And the PEG ratio is your price earnings divided by growth. Says you're not paying too much for the future growth at Chipotle Grill here. Or Chipotle Mexican Grill. That's the whole thing there. So we do see that on the growth, earnings were up 4.9% over last year. Industry is up 6.4%. Now, the 5-year for the earnings is pretty good. It's 46% versus 15%, but it looks like the growth is slowing down. Sales are up 7.3%, above the industry of 5.1%. The analysts for the 5 years going forward do give them a pretty good growth rate of 19.2%, well above the industry at 6.6%. They do not pay a dividend, no dividend there. On the balance sheet, got a current ratio of 1.5 versus 1.1. That is good. Debt to equity 1.6 versus 1. I'm a little bit uncomfortable with a debt to equity of 1.6. I don't like it much above 1.3, 1.4. We do see a net profit margin of 13% versus 8%. Return on equity very good, 47.7%. Return on invested capital is 18.7%. Free cash flow is not as good as I expected it to be. It's only $1.5 billion. The industry's at $3.1 billion. So I would like to have more cash flow from this company based on what we've seen in the past. But it looks like the past is changing to the future here.
Yeah. Well, let's look at the current numbers here for Chipotle. Again, their ticker symbol CMG. It's $30.56. 52-week range, the low here, $30.48, and the high $66.74 year to date. I mean, this stock has just gotten crushed. It's down almost 50% in that year to date period. Over the last 5 years, you're up only 15% now with that huge pullback. And this was one, again, it was like, wow, Chipotle just keeps going up and up and up.
Keep buying it. It's going to be great.
And now that return has been cut down pretty substantially.
You get the
10-year return still decent at about 169%. But looking forward for Chipotle, this still, I'm going to say, surprises me. Even with a 50% decline, estimated earnings per share of $1.24 gives a target sale of just $20.58. Forward PE still over 25. I mean, that is expensive. And earnings now, I mean, before maybe you used to be able to justify it because it was in such a high growth phase. Now earnings are estimated to grow 3% this year and 6% next year. I mean, that to me is very lackluster growth for an above, and I'm going to say this, an above expensive market multiple. It trades at a higher multiple in the S&P 500, and you're getting less growth. And the S&P 500 multiple is crazy expensive too. I mean, this to me is still not a good value, even with a 50% decline.
In actual last 9 days, I mean, their earnings estimates are down quite a bit. They're down about 12% here, 12.6% to be exact. And a big one over the last 30 days went from $1.37 down to $1.24. So this was a high flyer, and it did very well. And actually, you said 160%, not too bad, but the S&P did far better than that.
But it all came in that
beginning.
Prior 5-year period.
Yeah.
Right?
Yeah.
Not the most recent 5-year period. It all came, years 1 through 5 rather than 6 through 10.
Yeah, because the last 5 years, you lost money on it.
No, you're up 15%.
Oh, well, we'll say 5 years.
You're done okay. Yeah.
Done okay.
No, yeah, you haven't made money.
No. Yeah, you do better in a bank
Much
account.
money. Yeah.
So, but I think you got some news on it too, though.
Yeah, I mean, the big thing was obviously they tumbled after reporting some weak quarterly numbers, and this is what's interesting to me. The company now expects fiscal 2025 same-store sales to weaken by a low single-digit percentage rate. They still are expecting revenue growth next year to be 11 to 13%. The street was looking for a 15% growth. That tells me if you're not getting much same-store growth, your brand is not growing. People aren't going to your store more often. The only way you're growing is by opening more stores. Opening more stores comes with risk as well because that's more expense, and it could be potentially causing a bottom line not to grow that much.
And the buzz that I've been reading about them is that they're saying their target market of 25 to 35-year-olds, they're just not going as much. They're saying, gee, I can make this burrito myself at home for less price. Things got a little bit tight, so I'm not going to go to Chipotle. I'll just make it at home myself. So their sales are down. Their customer, who is not a high-end customer, is just saying, and some people used to go there, said 3-4 times a week. Nah, I don't do that anymore.
I mean, the competition's out there too. I know Kava, they reported some issues too, though. I mean, they had the same situation where foot traffic is slowed because it's the same demographic. But the problem is it's the same demographic. So people are choosing between maybe a Kava and a Chipotle, and that's maybe cannibalizing on sales as well. And the market can only obviously occupy so much of that decline.
And there's another one too that they talked about that came out too. It was Kava, and then somebody else. So it was
It's probably Sweet Green.
I think they mentioned as a Cane's is the new.
Oh, really?
Yeah, they mentioned Cane's is where is that 25
Fried chicken?
Yeah, that they're going there. Yeah,
There's one on Poway Road now.
I saw it. They built
I've never been. I've never been to a Raising Cane's. I'm
Is it spicy chicken?
sure you can get normal chicken.
No. Priscilla's sitting over there saying, nope. Have you had it, Priscilla? You've had it? Is it good? Yeah. Okay. She won't speak on air, but she does nod her head.
I have not been to a Raising Cane's. I've been to a Chipotle in, gosh, probably like 5 years too.
I've not been there in a while either. Yeah. So not a buy yet on Chipotle.
You won't see me at Chipotle, and you won't see me buying Chipotle stock.
No. So you might be excited about it, but I think their best days are behind them.
Yeah.
So let's move on to let's see, Newell Brands.
Yeah.
Newell Brands. I like that name. That just sounds kind of cool. And I know we looked at this company years ago. We decided not to buy it. Said, it could have some problems. Those problems did develop, unfortunately, for the company. Newell Brands are symbol is NWL. They're in the household and personal products industry. Wow, the short on this is 16.9%. That's pretty high. Unfortunately, they have no PE ratio, which means no earnings. We do see the industry is at 25.1. Price of sales does look good, 0.2 versus 2.5. Price to book value, 0.5 versus 4.9. But I got to point out, price of tangible book value is not material. So if you take away the intangible assets, well, then there's no value there. Price of cash flow is 5.2 versus 16.8. PEG ratio looking pretty good, 0.7. Now, the last year, there's no earnings, so no earnings growth. The industry was up 5.6%. Sales were down 5.9% when the industry was up 1.3%. Going forward, the analysts seem to be optimistic about this because a 5-year earnings per share growth estimates a positive 10.2 when they see the industry a negative 9.7. So maybe the industry thinks this is going to turn around, or the analysts think this is going to turn around. You do get a 9% yield from this company now, but with no earnings, there's no payout ratio. The free cash flow payout ratio is a negative 500%, so that's not very good. Let's take a look at the balance sheet. Current ratio 1.1 versus 1. That's okay. Debt to equity a little bit heavy, 2 versus 1.2. Net profit margin is a negative 0.3%, while the industry stands at a positive 10.4. Return on equity also negative 0.9% versus positive 27.4. Free cash flow is a negative $20,000, I believe that is $20,000, but yet the industry is at $7.6 billion. I mean, this company just seems like they're struggling for some reason. I don't know if you have any answers to that, or maybe things change going forward with the earnings. What do you got there, Jason?
Yeah, I mean, this company, it plummeted. It looks like about 28% after reporting quarterly results. That definitely missed expectations. It looks like guidance was really what took it down. They were looking for 56 to 60 cents per share, and that was down from a prior forecast of 66 to 70 cents. So that's quite a sizable cut. And they also see revenue declining by as much as 5% versus prior guidance of a 2 to 4% drop. So you don't want to see weaker earnings and declining sales. That's not a good combo. And the numbers here for Newell Brands, I mean, it's interesting. I mean, current price here is $3.11. Again, their ticker symbol NWL. And I say it's interesting because the 52-week range, the low $3.07 and the high $11.78. I mean, year to date, the stock is down 68%. Over the last 5 years, you're down 83%. Over the last 10 years, you're down 92%. I mean, it just gets worse and worse the further you go back. And you go forward, I mean, there's value here in terms of the earnings. You got to December 2026, estimated earnings per share is 64 cents. It gives you a target sell at $10.62. It trades at a forward P of about 5. I mean, that's pretty intriguing. But the problem is I worry about negative free cash flow, a weak balance sheet. I mean, this company could turn around or could go bankrupt.
And also, I see there's 11 analysts that come up with that number. The range is very high. It's a low estimate of 39 cents, a high of 85 cents. If you take 39 cents, you probably get a stock price somewhere around, $4 and change, probably.
Yeah, and I mean, I want to like it because it's got good brands. You know, it's got the Graco. Graco's the baby company.
Oh, yeah.
You have Coleman, which is the camping equipment. You have Rubbermaid, which is, your Tupperware. And they also have, trash cans. It looks like commercial products. Yankee Candle. Talk about Sharpie, Elmer's Glue, Papermate, the pen company. I mean, they have, decent brands. It just seems like maybe it was poorly managed and the debt fueled it to a dangerous place. That's
what I was thinking. They need Tim Cook to leave Apple, come over there and run the operations, because it looks like this company has good potential. You know what we could see with this is a corporate raider or something happen, somebody come in and take this company over, because they've got, I believe, some great products that are household names. Why this stock is at this level, why it's doing what it's doing, it's got to be mismanagement.
Yeah, I mean, this could be something that private equity could look at and take it private and turn it around, clean up the balance sheet, and make good money off.
Yep, I think you're right. Well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only. It should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter there. A lot of great educational information there for you as well. smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.